When it comes to investments and places to put your money, there's a lot of different asset classes, different sectors, and different tools you could use to put your money. As we've talked about a lot on this show before, there's many different ones that we've covered and dove into. And one we haven't talked about in a while is Index Universal Life or cash value life insurance. Watch this video as we discuss the pros of IUL. And in the next video, we'll discuss the cons. Hello, everyone. Thanks for stopping back by The Financial Beat. I'm Logan Sadler here, the host of the channel. Thanks again for stopping by. I wanted to talk to you guys today about cash value life insurance. It's been a little bit of a while since we've touched on this topic. And as you guys have known, if you've been watching the channel for a while, we've done quite a few different videos and now trying to circle back and take a little bit maybe of a deeper dive and highlight some of these videos. So today I wanted to talk about Index Universal Life Insurance or cash value life insurance. Now, as I talk about a lot about every type of investment or even every strategy, all of them are going to have a pro and a con, right? There's not one investment that is perfect. And I think it's very important to make sure they fit your situation. So before going out there and getting an IUL policy or anything like that, make sure you're talking with an advisor that understands your full financial situation and making sure it's the best fit. In today's video, let's talk about the pros, right? So what is an Index Universal Life Insurance, right? Basically, it's a spot where you could put money, either payments or lump sums, where you can get some cash value growth on that money. And you could also have some death benefits of traditional life insurance. There's a lot of different facets to break down in there, and I've done that on some other videos. Today, I strictly wanted to talk about the pros. Number one, there's going to be 6 of them, but number one is, potentially high returns. When you talk about the way that the Index Universal Lives make money, a lot of them track certain market indexes. Now, when you look at how those go, some of them will have an index of like the S&P 500 or a lot of different equity indexes that you can participate in. A lot of those have some genuinely, higher potential limits on those. Some of them might have a cap, which is the most you can make. Some of them might have a participation rate, which is a percentage that you participate in that index, right? So we have seen some of these, especially with rates being a little bit higher in today's current environment, we have seen some of these produce some pretty above average rate of returns, right? A lot of them, for most of you out there, when you're investing in an IUL, you're not thinking of it as your main growth sector. You're probably still using the market or real estate. However, these do typically perform better than bonds and typically better than money markets and CDs, and sometimes better than some traditional equity funds, depending on what it's in exactly. But some of these can produce very attractive returns for many of you out there, especially when you're talking about safe money. Number two, transitioning into safe money. A lot of these have a floor of 0, meaning if you have $100,000 in that index, and that index, let's say it's the S&P 500, and that index loses money that year, your principal is not touched on that. So you have a floor of 0, meaning you get some of the upside of it, but you don't get any of the downside. So for some of you out there, when you're trying to complement your market investments, this could be a very good way to use this as a bond alternative. There's a lot of studies out there lately that show IULs or even annuities in some cases outperforming a lot of those bond sectors. And when you're talking about the level of risk that they take is typically a lot less, maybe even substantially less than traditional bonds or bond funds. The other thing to remember is there is cost of insurance. So, even though you might not have made any money that year, the floor is 0, but if you have cost of insurance, that can come into effect too, but we'll cover that more on the next video. The third is the growth, right? The growth on this, if done correctly through policy loans, can have pretty much tax-free capital gains, right? They don't have capital gains, but so to speak, the interest earned on that, if taking out through policy loans, this is why a lot of our higher net worth individuals, we will use this to create that type of tax-free income into a plan in retirement. So that could be a massive, massive impact on that, as well as using that for tax-free policy loans, which can be a very, very beneficial thing for you in retirement, right? The next thing would be tax-free death benefit. A lot of you are aware that by putting money in Index Universal Life or any form of life insurance, you typically get a death benefit at the end of it. If structured correctly, there would be a death benefit left at the end of the policy that, if done again correctly, can go tax-free. So that's another big one. That'd be number 4 there, right? The next would be a lot of you out there that are 60, 62, 65, maybe 66 are ready to take Social Security. However, when you're taking Social Security, many of you might be aware, if you're not full retirement age, you typically touching IRAs or having earned income can sometimes make your Social Security be taxed, which can affect your Medicare and affect all the other things. The nice part is loan and withdrawals from the life insurance policy, they are not counted as income for those categories. So it would not affect your Social Security. So when you're working with your CPA and your advisor, this is one thing we typically like to throw in there as a caveat, where this could be a tool if we need income earlier in those early years of retirement, but are worried about affecting our Social Security and potentially taxes on that. That is where using IULs could be a very beneficial tool, especially for some of you that are maybe higher net worth and have some assets where we want to position them differently. And then number 6 would be the potential riders that they may have on these policies. Now, you do pay for these typically inside the policy. Some of them can have a long-term care rider. Some of these policies can be structured to utilize for long-term care, terminal illness riders. There's a lot of advantages, and death benefit riders, income riders. There's a lot of ways you could use these types of policies that can have some beneficial impacts on them, maybe outside of just growth, but maybe to help generate policy loan income, maybe to help generate death benefit, or maybe even to help utilize for long-term care. So again, 6 really, really important things that for some of you out there, as a portion of your plan, this may make sense to look at that. One thing I will say is IUL is not for everybody. Not everybody out there should run out there and buy a policy. I definitely think there's a lot of people out there pushing these, and they can be a great attribute to a retirement plan, but you want to make sure it's right for you. So make sure you're meeting with your advisor, giving us a call, whoever you're working with, making sure you're discussing this option and seeing if it's something that may fit and may benefit your plan. Stay tuned for the next video. We're going to talk about the cons of IUL as well. Enjoy.